All right. What is up, traders? What is up, tycoons? Look at this incredible move on the S&P 500, dropping down to 518, then rallying back up to 527 to finish the day. This is one of the most bullish candlesticks you guys can see. We're going to go over the SPY, but of course, we'll cover TLT and a lot of the recent developments. Now, we've been asking ourselves a question. Is this time different? Is TLT finally going to break out? And it looks like we got a little bit of false breakout just to come back down and come back right to that level again. So we need to dive in a little bit more thoroughly. And we're going to take a look at the daily time frame and also take a look at the 10-year yield analysis. The 10-year yield honestly has been the thing that's really keeping me on track when it comes to TLT. And we'll go over what it is that I'm paying attention there. And meanwhile, we've got stocks like DraftKings, okay? Lowest momentum we've seen in 2 years. We've got software stocks just absolutely getting obliterated. And then we'll go over a lot of the different indicators because the bearish move down to 518, a lot of people weren't prepared for and we're caught off guard. Now, members of the Discord, we already had our analysis saying, hey, below 525, we're most likely going to head down to 518. But there was a lot of warning signs just besides, simple price action. When you really dive underneath the hood of the market and you take a look at some of these other charts and different layouts that we've got, such as this, such as the Dow theory, you look at the advanced decline ratio, you look at the EPR model, we've got risk sentiment, gold copper ratio, new highs, all right, new lows, the skew, volatility, all right, and then we've got intermarket analysis with the tips and the NASDAQ, we've got TLT and SPX, commodities, and our inflation, basically inflation expectations ratio here. There's so many different things that you guys can look at underneath the surface, right? And this will really help you out a lot in understanding the market. We've also got stocks that look really strong. Okay. This is one that we've been paying attention to in the Discord for a while now. Okay. For really since the beginning of the year, we've been looking at MATX and Matson breaking out finally. Okay. Amazing. We've got tech software. All right. Software. We talked about how bad it's been doing, but when you zoom out, it's got the same setup here as MATX. Right. So this is one that I think a lot of people need to keep their eye on. We've got materials also setting up really nicely. This is a very bullish candlestick we just printed here on the weekly. Utilities looking super strong. We're going to go over an Elliott wave theory analysis here, and then we'll take a look at industrials as well. All right, we're going to break down all of the different signs you guys need to be paying attention to and a few stocks and sectors that I think you should pay attention to as well coming into the next month and throughout the rest of the year. So it's going to be a good video. Be sure to smash that like button, subscribe to the channel if you guys are new. But as always, the content on the channel is for informational and educational purposes only and is not intended to be relied upon as legal, financial, or investment advice. So be sure to read through the full disclaimer. And I also started a completely free newsletter for you guys. I'm going to be publishing a lot more on there. All right, starting in June. I've got a new schedule worked out. I've got a lot of things coming to the Discord as well. Okay. So there's a newsletter that also has a website with it. So you can go back and read some of the previous articles. All right. That's completely free. And then we've got the investment intelligence trading group. All right. Today is the last day, May 24. Promo code May24 will get you guys in for $1 for your first month. And I've been doing that throughout the month of May just to let people get in while I have some new changes coming that I'm going to be rolling out over the month of June. Okay. So if you join with that discount code by the end of the June, all of the new features, all of the new packages will be live and you guys can get access to that. I'm going to be posting 20 plus swing trade ideas every single week. There's going to be lots of custom scripts and indicators. And these are going to be the things that I use, right? These are basically just going to be like, hey, these are my, thinkorswim, scripts that I use to day trade, that I use to swing trade. There's lots of exclusive intel in there, right? There's a stock bot in there that can get you unusual option activity, dark pool data, gamma levels, so much more. And then exclusive chart layouts, right? Now, a lot of the charts we're going to go over in today's video are included in the several chart layout packages, but this isn't all of them. There's many more. And once you start to gather, gain the knowledge and gather the resources for all of these different things, you guys are going to have a huge edge in the market. And it's what's really helped establish me an edge in the market over my years of trading. Now, let's get back here and start on the S&P 500. Right here. Initially, the initial analysis before today's insane candle was this right here. outside candle. We have a top forming, we have a top forming. Last time we saw a rounded top with an outside candlestick, meaning that we have this candle here and we have a candle that opened above and closed below. So it opened above, it opened outside, and it closed outside the previous day's candlestick. We saw the same thing over here recently. That's a pretty bearish signal. And so we're seeing this, and I'm telling everyone, hey, 525, right? 524.94 was the, level that's right here, but it's basically 525. I was telling people, hey, below 525, we're coming down here towards 518, which is going to be that Fibonacci. And you can see we were just pennies away from it, guys. We were just cents away. We came down there, and what did we see? A massive amount of buyers. Now, this is our volume profile right here, but it's anchored specifically to the previous all-time high. So this is going to tell you where all of the buying and selling, where all of the volume has occurred. And you see that the point of control also aligns right there with that Fibonacci. And that's where we got an extremely strong bounce today. I mean, we literally went from 518 all the way up to 527 in a single day. That is a massive move, guys. That is a massive move for the SPY to make in one day, especially on a reversal, right? Because you have to remember, we opened up here. We opened up around 524, dropped all the way down towards 518, and then rallied up to 527. I mean, this is just an insane trading day. I'll be honest, right? And this candlestick right here is extremely bullish. We've now got an outside candlestick. So this is an outside candle that is a bearish engulfer. This right here is an outside candle that is a bullish hammer candle. Okay. I mean, this is extremely bullish. So we're going to see how this moves forward in the future. But above 525, we look really good to start retesting all-time highs right around 533, if not potentially make new all-time highs in the S&P 500. 525 is still going to be that key level for us. Down below there, we will be looking for more bearish potentials. All right. Now, if we look at TLT, this time is different. That's the question we've been asking ourselves, right? Because we've gotten rejected so many times. And if you looked, it looked like we were breaking out, retesting to move higher, but we didn't. We did not. TLT's been pretty tricky, right? Especially when you only pay attention to TLT. I mean, we look here, we've got the inverse bump and run pattern, which if you're not familiar with it, this is a really good chart pattern that I want you guys to start learning and understanding. You have a prevailing trend. So in this case, it's a downtrend, right? This is your prevailing trend. And then you get this aggressive bump down in the price. The run is when you break through that trend line. So many times, guys, I mean, I'm telling you, if I see this pattern, I'm buying the breakout. Okay. I'm buying the breakout candlestick. If we open and close above, an inverse bump and run, I'm buying that candlestick and I'm holding and I'm looking to see if we can get a move up towards the second trend line, right? Now, you can be a little more precise and have some specific levels. In TLT, for instance, we were looking right here at 92. That was our key level, taking profit there, and then looking to see if we could break out past the second trend line. In this case, we didn't, right? We came up towards that 92 level, got around 92.50. We saw a pullback. Now, we had an extremely large sell-off in TLT. We had in just a matter of days, we saw over a 3% drop in TLT. And, I was telling people, hey, this is, if you're bullish on PCE, which PCE came out today, all right, this is your personal consumption, personal consumer expenditure or something like that. I don't even know these days anymore. Every single inflation data is like watched upon like a hawk, and it always causes, big spikes in volatility and big moves in the market. PC is another one of them, okay? And what we're seeing here was a strong reaction, right? We gapped up initially on TLT, very, very nice. And, when we were coming down here and I was saying that this is a big sell-off, just in 2 days, I've got OPEX expiration, so June 21st, right? So not even options that expired this week that were weeklies or expire next week, but options that expire on June 21st, they already went up almost 100% if you bought down here after TLT had this massive 2-day sell-off right here. So really good short-term opportunity. A longer term, we're above this anchored VWAP, okay? And a VWAP is your volume-weighted average price. All you have to think about it as is, hey, above a VWAP, bulls are in control. Below a VWAP, bears are in control. And if you anchor it where you get the A VWAP, you anchor it to a specific point in time. And so we anchored it to the most recent lows. And we want to see, hey, where did the bulls lose control? Well, they lost control right here, right? Right here on this date when we gapped down the next day before or the next day after. But what ended up happening, right? A little bit of an oopsie is what it looks like to me. It looks like bears got a little too excited here and they weren't able to maintain the average seller in control, and now we're seeing buyers are back in control above this anchored VWAP. Above the anchored VWAP, in a general sense, I like TLT for longs, okay? And I do think it has the potential to come back up and retest, these $100 highs. But there's a lot of work to be done, okay? Lots of work to be done. The most important signal we want to pay attention to right now is going to be your MACD. All right, the MACD has provided really great buying and selling swing trading opportunities. I've broken it down in all of my TLT videos, so I'm not going to spend too much time on it. But it's curling right now. It's chopping around. We see it crossed over to the downside, and now it's starting to curl back up. If this thing crosses back above, that's going to be a good buy signal for us, okay? Good buy signal for the bulls. So I'll be watching to see what happens there. Or if we lose the anchored VWAP, I know sellers are starting to take control, and that could cause this MACD right here to continue heading downwards. Now, the 10-year yield. The 10-year yield is what has me more confident in my TLT analysis, okay? And we've got some Elliott wave measurements on here. We're not going to spend too much time on it and break things down. But overall, we're looking at a larger cycle wave 3 that was completed or, was completed up here. And we're looking for a larger cycle wave 4 to be completed. Now, your wave 4 should come in a corrective wave, all right? A corrective wave is going to be a 3-wave structure, an A, B, C. That's what I'm tracking. Remember, if yields move lower, bonds move higher. That's their simple structure. That's why I like trading bonds so much, like trading TLT so much. And I mentioned, a week ago, hey, it looks like we're hitting wave 1 territory. We're expecting a move up. We're expecting a move up in the 10-year yield. If you're expecting a move up in yields, you're going to be expecting a move down in bonds, right? It's just that simple. And so this sell-off wasn't too surprising to me, but when I noticed that we had a over 3% sell-off in, roughly 2 or 3 days, that is something you don't see, right? And I know this because I trade the bonds a lot, and I can tell when we have these big overreactions, right? Take a look at here. When we gap down one day, gap down another day, we gap down, but then we ended up closing higher that day. We had a green candle at the end of the day. Same thing here, right? We ended up gapping down. We come down, and then 2 trading days later, right, we're gapping up both days, closing higher. So really strong price structure, from that standpoint. And if you look here, we were expecting this wave 2 up, and I told you guys, hey, 4.5, right? 4.53 was that level we were looking for wave 2 to come up and hit. But these are just rough structures, guys. Look, the drawings are here before the candlesticks are here. These are just guidelines, right? They're not things to specifically live or die by the exact price level. It's more of a guideline, and the guideline looks really well. We're seeing the 1, 2, and if this is the top here on the 10-year yield, the short-term intermediate top, and we see this continue head lower and break these lows, that's going to give us confirmation that we're in this wave 3 here, and we're going to be looking for ultimately a retest of the prior lows around 3.78. All right, let's just call it 3.75. And if we break through there like we should, we don't have to, but most ABC structures, they come in a form where you see a move down here to a 1.0 extension, which would take us to about 3.5. Okay, so, we're looking for anywhere from 3.75 down to 3.5, all the way down to about 3.25 on the 10-year yield. That's going to be a huge move, guys. All right, look at where the 10-year yield was when it bottomed this year. And, look at where TLT was at 100, right? If we get that move, TLT should technically go past 100. It's just a matter of, will this play out? And to me, a lot of it is following very well, right? The bonds really follow technical analysis very well. And that's something a lot of people don't understand. They think, oh, you're an idiot. Who's wasting their time doing TA on bond yields? Well, there's lots of people, guys, lots and lots of people doing this. Now, let's get into the stock market, okay? Before this amazing turnaround today, it was brutal, right? There was a lot of pain in the market, lots of sell-offs. Look at DraftKings, guys. DraftKings RSI, okay, so momentum is hitting its lowest level that it's hit in over 2 years. This is crazy, guys. This is a big sell-off, right, in DraftKings. And if this thing comes down to the 34 to $32 region, I think that this could be a potential buying opportunity because you know what you see happen in bull markets, guys, is you see a lot of failed bearish plays or bearish scenarios play out. And what do I mean by that? Okay, well, we've broken a major uptrend here. Your bear, all right, a lot of extreme bears, they're the people that, are perma bears. They're going to tell you it's coming all the way down here. I doubt that DraftKings is coming all the way back down to $10, especially being that we're still in a bull market and especially with the really strong reaction that we saw in the market. Now, does that mean that it can't head lower? No, that doesn't. But our first area of interest is going to be at this 34 to about $32 zone right here because this was old resistance, all right, old resistance that turned into new support. And if we break through this uptrend line that we've got here, this is the logical area for the bears to get trapped. Okay, and essentially cause a short squeeze where bears get over aggressive here because they're looking and they're saying, all right, we're back at this previous level. If we break through here, we're going to see a flush down to 25, right? That's what bears are going to be looking for. So if they get too aggressive in this area and the bulls step in and push price higher, well, now the bears are going to have to cover their short positions while the bulls are buying, and it's going to push things back up potentially. So I think DraftKings, while it does look terrible and while momentum looks bad, right? This isn't like a top of the list, name for me to buy. Because at the end of the day, we are in a bull market, and I want to see stocks that are showing strength, right? Not weakness. I want to see stocks that are showing positive momentum. DraftKings lowest momentum it's seen in 2 years. So it's not top of the list, but there is a really good risk reward opportunity here, right? If we come down to 34, and you're risking $2 or $3, right? You stop loss at 31, stop loss below the 32 demand zone, and you're targeting previous cycle highs at 48, or you're targeting a retest of the trend line, etc. You can set yourself up for really nice risk to reward ratio trades. All right, look at tech software. All right, software has really been dragging the market down. Right, last time we saw a rounded top up here, we had bearish divergence. Rounded top up here, bearish divergence again. And we're seeing these things play out very, very similarly. Again, you're seeing extremely low momentum readings. But look at where we were last time we had these low momentum readings. We saw a nice rebound. Now, this is often what happens in a low and weak momentum area, okay? Which is why I was saying that DraftKings is like not top of my list. Like, yes, there can be a bounce, but is that stock going to be making new all-time highs anytime soon or new 52-week highs anytime soon? Probably not. And that's something you need to be aware of with IGV is that, you take a look here and we came down. Again, we saw oversold readings on momentum over here. But what did we do? We printed a high and then a lower high. That's what happens when you're not in a strong momentum cycle is you get the rally, but the rally falls short and creates a lower high. And now we have lows, lower lows, lower lows. So you do need to be cautious of that because look what happened last time. We came back down into the zone. We saw a bounce, high, higher high. Ultimately, we head down lower and create yet again another or lower high, right? High, lower high, lower high. So that's one thing we do want to be cautious of, okay? If I'm being honest, is software. You need to be a little cautious of software. But there's lots of opportunities in software because of this big sell-off. We'll get into that in a little bit. But first, let's take a look at some of the warning signs that we had in the market saying that things were potentially about to break down. The first one we're going to look at is the McClellan Summation Index. So that's going to be our indicator on the bottom here. And all I'm doing is simply pointing out divergences, right? You see higher highs here, lower highs here, ended up leading to a sell-off. We see low, lower low, we see high, or we see low, we see higher low. Divergence, okay? A divergence is when this is doing one thing, this is doing the opposite. And oftentimes the indicator is going to be, a potentially a leading indicator at this point of the divergence to signal what could happen in the S&P. Here, again, higher highs, lower highs, we sell off. Higher highs, lower highs, we sell off. Lower highs, higher highs, we've sold off again. So This is something you guys want to learn how to use, the McClellan Summation Index. This is one of the charts included in the chart layout packages, and it's something really, very useful. We really want to see this thing ultimately, guys, start making some higher highs here. All right, because look at what we've done. We've made a high, a lower high, and a lower high. We really need to end this downtrend that we've got here on the McClellan Summation Index and look for a breakout on this to really suggest and give confidence in a strong move to the upside versus a much more muted move to the upside, right? Where, we did make new all-time highs, but look at what we did, right? We made new all-time highs, then came back right back down and broke through those previous all-time highs and fell lower, right? This is another one here. Transports have been holding the market back. Now, this chart right here basically emphasizes the Dow theory. And so we've got transports in the middle here. Transports are the ones you want to pay attention to. We've got the Dow Jones Industrials and the S&P right here on the bottom. But take a look how the transports, they topped out before industrials, before the Dow Jones Industrials, and before the S&P 500. You guys see that, right? It hit a top first. Oftentimes, it can be a leading indicator. Well, what happened here later in the future? It also bottomed before the S&P 500, right? So we see it as a leading indicator as a top and as a bottom. And what have we seen here? While the S&P has been making a high and higher highs, the Dow Jones Transport has not even made a new all-time high yet. It's actually made a high, a lower high, and then a lower highs again here. We really want to see participation from those transports. That's really going to help give us confidence in a market rally if we can start to get the transports to really break out and make new all-time highs. So I think transports are something you really want to pay attention to. This is one of those warning signals, guys. This is a warning signal basically saying, hey, we're seeing the market move higher, but perhaps it's not justified, right? Because we're seeing a Dow theory divergence and negative divergence at the moment. Another thing also is the advanced decline ratio. Okay, this is a new indicator that I've created and have started using. And, all we're doing is exactly what we're saying, right? We're taking a look at the ratio between the number of stocks advancing, the number of stocks declining. And in my experience, once you're above this 3 level, okay, that many times has literally pointed out a stall out or a drop period in the market, right? Anytime we've been over there, take a look here where we cross over. What happens shortly afterwards? We drop. Take a look here when we cross over. What happens? We drop, right? And I've highlighted all of these on the chart. And you can see there's some periods where we just go sideways. We go sideways here. We drop here, sideways, 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 sideways. Here we see an acceleration, right? But then we drop here, we drop here, we drop after this signal. We have a small drop after this signal. We rally after this one. A majority of the time when you see this signal, it is a bearish indicator. And this is something that I want you guys to start getting familiar with. And this is one of the brand new chart layouts that I'm introducing and rolling out. We've also got the EPR model, which is an employment population ratio model. What we're looking at here is the great financial crisis. Okay, we're looking back at 08, 09, right? And this model is really good because it points out, cautionary signs. When this thing starts to turn yellow, that's essentially a sell signal, right? And that can be a sell signal. Now, it doesn't always have to be a sell signal, but it can be a warning sign. And then when you see it turn red, that is like, all right, no bueno. Like, please do not try and invest in this market. It's going to see more red, right? And you can see from those periods here where it's red, it was in a very strong downtrend here. But once it goes from yellow back to green, that's a buying opportunity, right? And you can see here we have a strong uptrend until we see the next one heading into the great financial crisis. And what do we see? Again, another very large sell-off. And then we see it turns green back over here. And that's a signal to, get back into the market. The EPR, Employment Population Ratio Model. It's basically a more sophisticated way of looking at things like unemployment. A lot of times people look at unemployment to predict recessions. A lot of times people look at the inverted yield curve. If a yield curve is inverted, typically that always precedes a recession. I really like this employment population ratio model. And this is a monthly indicator. Okay, so each one of these ticks down here, each one of these bars represent a month, a single month. So a lot of these are multi-year signal periods, right? Where you can see, all right, for a few years here, this EPR model was telling us don't invest in the market, right? We're in a downtrend. It all depends on, what type of investor you are. If you're someone who is investing for the next 5, 10, 20, plus years, you may want to be buying in these downtrends, right? You may want to be buying while things are making new lows before they make new all-time highs. But if you're someone who's more focused on, the next year or the next 2 years or 3 years, this EPR model is really going to help you out a lot for having confidence in buying some of the dips, right? You can see there's plenty of dips in this area here where, it's still all green signs, right? And that's a good sign that, hey, you know, there may be things that spook the market or there may be fears, but ultimately everything is still clear to continue buying, right? And then we see that flip again right before the great financial crisis. And that was a warning sign. And that's where we're at right now is we've gotten 2 readings in a row now on that EPR model for yellow. So if you're a perma bear or you're someone who's super bearish on the market, that's what you're looking at right now. That's one of your bearish cases, just like the transports, right? We look at the transports. This is another one here. We're seeing the S&P 500 on the top. And when you take a look at high beta versus low volatility stocks, it's gone completely sideways. You take a look at discretionary versus staples, it's bearish. You take a look at biotech, it's bearish. This is a risk sentiment analysis chart. When you see all of these going down, right? 1, 2, 3, 4 of these measurements going down, it really gives you strong confluence that, hey, this bear market that we're in the SPY in 2022 is very strong and very justified, right? There's not really any reasons to expect us to come out of this bear market. But you look here where we had lows, we had lower lows, then we had highs, lower highs, or lows, higher lows, lows, higher lows, lows, higher lows on 3 out of 4 of our measurements here. This is telling us, hey, this could be wrong. If we look beneath the surface, the market is actually getting more bullish here and starting to turn around when you dive underneath the hood and you take a look at the internals and market breadth. We see what we're seeing right now, and we're seeing a lot of warning signs that things could be falling off, right? And that's one of the things that's caused the most recent sell-off, or caused the previous 5% plus sell-off and caused the most recent sell-off. This is the thing where you're going to look at this and you're saying it makes sense, right? We're not really seeing any of these charts breaking out or making new highs. The only one that's holding up here is credit spreads. And oftentimes, credit spreads can really be if I forget who it is, but someone said, what's the one indicator that they could look at, right, to really give them the most confidence in the market, right? Whether or not we're risk on, risk off, whether or not we're bullish or bearish, and credit spreads. Okay, credit spreads. If you look at credit spreads, they have held up very, very well. And initially, when we had that bearish divergence, or when we had the bullish divergence with lower lows on the S&P, but higher lows on the credit spreads ratio, it really ended up marking a bottom that ultimately turned into the bear market bottom. And we haven't seen a negative divergence on that. Is it rising at the same pace of the S&P 500? Maybe not, right? Maybe it's just chopping around a little bit more, but things look very healthy in the terms of the credit spreads. It's really all of these other ratio measurements. All right, sorry about that. I had to sneeze really quick. Let's take a look at another thing here. For all you perma bears, are we about to crash, right? Is the market about to tank? Are we about to go into bear market and go into huge recession? While we're seeing these warning signs of a drop, this gold copper ratio is a really good instrument and really good tool. Another one of my chart layouts that I have available for the Discord members, as well as, starting tomorrow, I'm going to be selling a lot of these different chart layout packages. This one right here often gives you warning signs and tells you and predicts, just like an inverted yield curve, of a recession. And so we had a little bit of a warning sign here where we saw these aggressive upticks in the gold copper ratio, right? Typically, right, in a general environment, right? Generally speaking, right? Not speaking for super precise, cycles or anything like this. Gold rising, oftentimes people look at gold as a flight to safety. Copper, oftentimes referred to as Dr. Copper, is looked at as a state of the economy, right? Is it strengthening or is it weakening? So if gold is outperforming copper, it's suggesting that investors are more risk off. Okay, they're looking to invest in gold as a safety asset, and copper is falling, which could be, or copper is underperforming gold, which could be indicative that the economy is weakening, or investors think that the economy will weaken in the future. Now take a look. You oftentimes get these big spikes in the gold copper ratio, all right? And then shortly afterwards, right, you see it drop back down, and then you see another massive run up period here. And these warning signs marked in yellow often precede recessions and bear markets. All right, this happened right before the great financial crisis in 2007. And then what do you see? You see, the great financial crisis sell-off. Same thing over here in 2015. We ended up seeing a warning signal again where we saw a large spike in the gold copper ratio. It didn't break out past its previous highs, but it spiked back up to those previous highs, which is a warning sign for us. And shortly afterwards, we see it dropped, and then it went on a very strong rally, and the S&P went into another bear market. It even happened during the pandemic of 2020. Again, we saw a warning sign, a sharp spike up in the gold copper ratio. We see a decline, and then we ended up seeing a bear market. All right, take a look at what we've had. We've had an increase here in the gold copper ratio, and now we've seen a decline. So we do need to be cautious of this. It's not telling us that a recession has really started. If the gold copper ratio starts to make some new highs here and really starts to accelerate, and we really see gold outperforming copper tremendously, that's going to be a warning sign of a recession. Okay, so again, a lot of this is some of the bear food, right? Some of the bear fuel. And these are things that you guys need to know about. If you're a bull, okay, you need to be aware of what are the bearish scenarios? What is the bearish thesis? What's the bearish case? How can I argue against the bears? Right? Same thing if you're, a bear. You need to know the bullish cases. How can you argue against those bullish thesis? So it's really good to look at all of these things from an unbiased view and then let them tell the story. Let them paint the picture, because the market is always telling you a story. And too many people are focused on an individual ticker, individual sector, to really notice what the market is telling you as a whole. And diving through a lot of these different chart layouts is really going to give you an edge. This is another one here when you look at new highs. So we've got the S&P here. This is the number of stocks making new highs in the stock market versus new lows, right? Or new highs. And what do you see over here? Back in March, April, we started to see a decline in the number of new highs. We saw, stocks making new highs, stock making less new highs, stock making less new highs. Take a look at what happened back here in late March and early April. The market topped out, right? We topped out here at this period, and we saw a decline. What are we seeing here again in May, in early May? Well, we're seeing about midway through May, we topped out. We're declining here. Okay, so the market is pulling back, declining, and we're seeing less new highs being made on a 1-year basis. We're seeing less new highs being made on a 1-month basis. We're seeing less new highs being made on a 6-month basis. Guys, you can't make new highs without making new highs. Does that make sense? I mean, it should be that simple, right? But a lot of people don't understand how to look at these measurements. They don't understand that the stock market is literally a market full of stocks. So you need to actually count the individual names, okay? You need to actually take a look at the individual data. And even though we see the S&P rising here, even though we see it rising here, we're actually not seeing new highs in stocks on a 1-year, 1-month, 6-month basis. And that ended up leading to a sell-off here and leading to a sell-off here. These are things you need to pay attention to. This is another way you can visualize it, right? Maybe this way is a little bit easier. I have a couple different layouts because I don't know which one's my favorite personally. But take a look. Bearish divergence, guys. Right? We're seeing new highs being made, but we're seeing lower highs being made on, the percentage of stocks making 1-year highs. All right, if I come back in here and draw that again, right? We see lower highs, but we see higher highs at these points, right? Again, higher highs, but we're seeing lower highs. Again, higher highs, but we're seeing lower highs. This is warning you and basically telling you guys all at this time that we're making new all-time highs in the S&P, is that even though the broad market index, all right, or the broad market ETFs are making new all-time highs, stocks are not making new highs on a 1-year, 6-month, or 1-month basis. That's a warning sign, right? And what do you see? We ended up dropping afterwards, right? Again, this is what happened over here, right? Throughout these periods here where we're making new highs in the market. Okay, but we weren't seeing new highs in 1 month, 6 month, or 1 year trading time basis. Okay, so these things, when you start to realize this, and you're like, hold on, the S&P is making new highs, but the amount of stocks making new highs has been going lower continuously across different time measurements. That's not really a great sign. Now, what we're looking at here is new lows, and what do we see? We see an uptick in the new lows, right? So that lets you know that, hey, this sell-off is making a little bit of sense because we're starting to see the number of sell-offs or the number of stocks making new lows on a 1 year, 1 month, 6 month basis. We're starting to see an increase in this, right? We're starting to see stocks selling off. So, for the market to move lower, again, you have to have new lows in stocks because at the end of the day, the stock market is nothing more than a market of different stocks. And these are really good ways, really simple ways, really visual ways that I've tried to make it easy as possible for beginners, people who are new, to really understand these concepts, guys. And it's not tough, right? When you have all of these chart layouts saved or you have them easily accessible as I'm making them for you guys, you can just quickly run through these, right? You won't need to spend an hour analyzing this chart, right? You can look at this chart and just see, hey, are we seeing, the number of new lows rising on different time bases? And we are. So we know that, this pullback is making sense, right? Are we seeing the number of new highs rising as we're making new highs? Well, we're not, right? And so that doesn't really make sense. We're not really seeing new highs. Why are we making new all-time highs, for instance, right? That's a way to look at it, a way to think about it. Now, another thing you can look at is going to be the skew, which we have the skew on top, the S&P on the bottom. There is this really amazing long-term buying opportunity zone, which is just above 110 on the skew. Anytime we come into there, guys, it is a great long-term investment hold. If you're looking 5 years, 3 years, just a few years into the future, 5, 10 plus years, these are magnificent buying opportunities. I've highlighted them all down here. And if you look, if you were just a long-term investor and buying at these opportunities, and again, having a multi-year time basis, right? Of course, there was this big crash here during the pandemic. But if you take a look back here, back to 2016, a great buy signal, right? And almost a decade later, the S&P 500 has gone up over 100%, right? Same thing over here. The S&P pretty much has gone up over 100%. These are really great long-term buying opportunities. But they also provide really good short-term selling opportunities or short-term areas to be cautious or hedge your portfolio once we start trading above 146.50, 154.50, 170.50. A lot of these levels, it's very common for us to see pullbacks in the market whenever we come up to these extreme levels on the skew. So that's something to keep in mind. Oftentimes, you're going to see the skew moving in the same direction as the S&P, right? So if the skew is moving up, that's generally a good sign for the market. But we have these levels here where we know, well, hey, the skew sometimes tops out at a lot of these levels. It's very common for it to top out at these levels. And if it does move with the S&P, well, that could cause the S&P to drop if some of these are dropping. And when you take a look at volatility, which I had a whole video on volatility about a week ago, talking about how volatility has re-entered the market. The key signal for volatility and spotting volatility in the market is not so much the VIX these days. The VIX is not as good as an instrument as it used to be, but you can still use it, right? What I like to do is take a look at some other volatility instruments as well. And we've got the VVIX right here on top. And you notice last week, the VVIX saw a strong spike. It actually broke above its resistance level. The VVIX or the VIX itself, we talked about how it was nearing support and breaking down and how we need to be cautious, right? Because at any moment now, we would be expecting support to come in for the VIX and see a rise in the VIX. Now, sure enough, we saw the spike last week in the VVIX, okay, which is the volatility of the volatility index. And then we see the volatility index spiking up a week after. It's not really a coincidence, guys. It's very common for you to see the VIX be a leading indicator for the VVIX be a leading indicator for the VIX and for volatility. And of course, as volatility increases and the VIX increases, it's very common to see the market move lower. So, These are a lot of the warning signs, guys. I know it's complex. I know we went through a lot. Pay attention to these. Start to learn these. All right. I've got chart layouts available for purchase, really showing you guys all of these things. All right. Now, they're going to be available for purchase in June. Remember, if you join the Discord right now, you'll get access to all of these, and it's only $1 for your first month. So while all of these are being released in June, you can get access to them and then decide if you want to stay in the Discord and keep access. Now, the bond market, okay, is often a really good proxy for the stock market and can be a leading indicator. And if you want to look at tech stocks and you want to know what a potential leading indicator for them is going to be, well, you're going to look at inflation protected treasuries. That's going to be your TIP ETF. Look at all of the divergences, guys, right? We keep going over these divergences, all these different signals, and a lot of times you'll see many of them align at the same exact time, not just one or two. You'll see multiple align. And when you see multiple things align, such as the new lows versus new highs, you take a look at the skew, you take a look at, the tip, the NDX, and so many different things, guys. So many. You'll really start to gain an edge and be like, all right, hey, there's lots of warning signs of risk off, lots of warning signs of risk on. If you're a bear, hey, maybe I don't want to be so bearish right now. We're seeing a lot of internals, breadth, and intermarket analysis suggestions that things are going to go higher. And we've seen this bearish divergence, guys, and it played out here recently where we saw a sell-off in both the tip and the NDX after making lower highs in the tips, but making higher lows in the NDX. We did get that sell-off. And now what we're wondering is the tips ratio chart, or is the tips right here going to break out? If this thing breaks out and starts running, that could be bad for tech stocks. And we talked about how weak software stocks in particular in the tech industry, so software as a subsector has been performing. Now you can use TLT for the S&P, okay? And again, you see these negative divergence periods oftentimes where TLT is a leading indicator. And sure enough, we're in that period here now where, again, TLT is still in its downtrend, but the stock market is still in its uptrend. And we started to see a sell-off in the market, just like the sell-off we saw over here. Another thing to look at, okay, more specifically for the bond market, but also pertaining to inflation-sensitive stocks. This is a really good chart layout showing the commodities index on the top. And then this is basically inflation expectations on the bottom measured by the tip divided by the IEF. Okay, so that's going to be your inflation protected treasury securities versus nominal yielding treasuries. And initially we saw what we thought was a false breakout. Okay, and this was a good opportunity, spotting this ahead of time to short TLT, short something like TLT. And now what are we seeing? Well, this could potentially break out. If this chart right here breaks out, guys, this is something you're going to want to be aware of for TLT, because it means that the market is pricing in higher inflation, higher inflation expectations. Higher inflation expectations mean a more hawkish, less dovish Fed. And if the Fed is not dovish, well, then they have no interest in cutting rates. If rates don't go down, yields don't go down, bonds can't go up. It's just that simple, right? So this is one of the charts that I'm paying attention to here, because the commodities index, which again, commodities are a measurement of inflation. If commodities cost more, commodity prices are going higher, that spills over into the CPI report, that spills over into inflation, because the cost of goods, cost of commodities are rising. Just that simple, right? We can see that it's still broken out past its October highs, right? We saw October highs in both of these. And these are broken out, right? Commodities are broken out and it's holding above. Meanwhile, our tip IEF ratio chart here broke out, but now it's retesting that level. So this is something I think you guys really want to pay attention to if you're trading bonds or inflation sensitive stocks. Take a look at copper futures right here and oil futures. Okay. Speaking of commodities, copper and oil tend to move very similarly. Okay, it's very common for you to see commodities move in unison. They're not going to have the exact same moves, but look at how very close these charts mirror each other. And there was a divergence between here. Okay, and so what this is telling you is that one of these charts right here is lying, because what are we seeing? Well, we're seeing lower highs here, but we're seeing these massive higher highs here. And sure enough, oil futures, all right, were the leading indicator for copper futures. really being suggestive that things got overheated here and that things were being due for a pullback. If we take a look, these are some names, guys, that are look really strong. MATX is one we've been covering for a while. One of the Discord members hit me up today talking about the most recent trade idea posted in the Discord on MATX, working out really well. We actually broke out above the price target today of 125. And now on a much longer term time basis, right, over the next 6 months to a year and a half, if not sooner, above 125.50, we're looking for 168 on MATX. All right. Now, again, this is a weekly time frame. This is a huge multi-year base, a 2-year base. This may not play out very soon, right? It may not play out in the next month. It may not play out in the next 2 months. It's possible for it to go from 125.50 to 168. But if you just think about it from a longer term perspective, above these breakout highs, above these previous cycle highs, you do want to be long these names, right? This is something showing strength. We just showed a lot of these bearish signals, a lot of different sectors of the market that are pulling back. This is not. And MATX is one of the top heavily weighted stocks in the transport ETF. This is a really great sign. If this stock can continue its momentum and not have a false breakout to the upside, right, where we do something like this, where this move essentially is just a fake out, right? A false breakout, a false move. And false moves lead to very fast moves, right? And if that turns into a false move that leads to a fast move, that's going to put even more bearish pressure on the transports. And we've already seen that negative divergence in the transports relative to the industrials, Dow Jones Industrials, and the S&P 500. So we want MATX to really start being, a leader and hopefully start seeing a lot more of the transport start to follow. Now, tech software, okay, software, IGV. If you look at this, also setting up a nice cup and handle. I mean, this was a great buying opportunity. This was the buying opportunity we talked about in, one of the most recent trade ideas. Now, coming back, retesting this key zone, if you can retest this key zone and get a move higher, well, you'll want to target the previous highs, but you also want to have room for the breakout to the upside. Look at this one, coming back down, retesting a previous zone. There's lots of software names that have been selling off tremendously, guys. I mean, Snowflake saw a nice sell-off, Salesforce saw a nice sell-off, and we're seeing a lot of sympathy sell-offs due to some of these other software stocks selling off. And it's been brutal. It's been one of the things really holding the market back, holding the S&P 500 back. Materials, guys. Materials were super hot, and we had a really great trade on materials, and we came out and we had a little bit of a false breakout here, right? We just barely got above the previous cycle highs here, above this key supply zone. But ultimately, we drop back down. And after this extremely bullish weekly candlestick print that we have here on the close, again, above 92.37 on XLB, I think you want to be long in targeting 97.50, 103, 108, and 112, right? These are your price targets to the upside, right? Meaning 97.50 is your shorter term target. And if you have a longer 6-month plus time basis, you can target some of these higher levels up here, because this has been a strong sector of the market, strong area of the market, and you want to play into strength. You don't necessarily want to always buy into weakness. That's my experience with bull markets. Look at XLU. XLU has been a really great one. We've been pointing out XLU for a while in the Discord. I had a couple good trade or two on XLU, and right now I'm tracking this type of Elliott wave analysis. This may not be perfect. This may not be correct, but it does seem to have been playing out very well. And a lot of these have ended up turning out playing pretty well here as well. So we got the XLU. We had initial falling wedge, very clean ABCDE structure. We love it when the wave E does not come all the way down and touch this trend line. Instead, it made a retracement here. So 1-2 setup. Wave 3 on this 1-2 setup is going to take us up to about 75 to 78, right? That is going to be the targets for this larger wave 3. Now, wave 3s, wave 1, wave 3, and wave 5, they typically come in 5-wave structures. Wave 2, wave 4 come in an ABC structure, right? And so let's just kind of visualize that really quick and talk about it, right? So you got 1, 2, 3, 4, 5, right? ABC here. A, B, C. So we are leaving the door open for utilities to pull back a little bit more and have a little bit more of a sell-off. It's something to keep open-minded about. Or you can just look to enter into strength, right? Basically above 73, we're going to be targeting 75.84 and 78.12 on the XLU. So there's a couple of different ways to look at it. But I am keeping an open mind. And if we do get a pullback and we top out around 67.5, or we bottom out around 67.5 to about $70 on the XLU, I think that that's a really good area to put a risk reward on, targeting some of these highs up here that I mentioned. Ultimately, though, the XLU looks like it's setting up for a really strong move over the next year or two, up to 85 to potentially $91. So I really like how utilities look right now. Industrials don't look good at all. Okay, let's be honest here. We've got a double top forming, right? Got a very clean double top formation. But we haven't broken through the neckline. Okay, so a double top formation is not confirmed until you break through the neckline. For now, this is just an area of support and this is just an area of resistance, and we're trading within a range, right? It's a little more easy to visualize if you draw a box here, guys. The average, YouTuber is going to tell you that, hey, this is a completely bearish setup and to sell everything. But what we've seen so many times this year are these false topping patterns, right? And this is one of the most bullish patterns that I've found throughout the year, really the past year and a half, is the plumber's pivot, where you have this false top, right? So, bears are coming in here and they're looking for a flush to the downside, right? And what happens is they get short at these areas looking for that flush to the downside. Rather, they end up getting squeezed out, and we see this plumber's pivot. And the reason it's called a plumber's pivot is because right here, okay, where we have this topping formation, bears are looking for the flush to the downside. They're unable to get the flush. They're in need of a plumber. They have to make that call. They have to call their broker and say, hey, I'm getting margin called on my short positions. I'm getting squeezed out. Close my shorts. Buy to cover, right? So you have people buying to open, people buying to cover, and that's what causes these really fast moves to the upside, where you see a false move, right? A bearish setup, a bear trap, leading to a really fast move to the upside. And if we were to just to apply that same concept, we've got a topping pattern here again, right? We've got a rounded top. Maybe we may dip below. Maybe we already came down and tested support. But what I think is a big possibility is, even if this does start to break down, we could see something like this, right? Again, where we see, a little bit of a false move here, a false top. Maybe it does a bear trap and sucks in some more liquidity to the downside in this area. But then we'd be looking for a strong move to the upside. So industrials, another one to keep an eye on, not one of my favorites, okay? A lot of things suggest that this thing could flush to the downside, but I know that in a bull market, bearish tendencies have, or bearish setups have a tendency to fail. So I'm not going to be overly aggressive short on this. But, there's no denying it's a very clear double top forming. And, we really need to pay attention and watch the industrials, right? I think that that's going to be a pretty important sector for the market overall. Hopefully you guys enjoyed today's video, okay? I post a lot of charts like this inside of the Investment Intelligence Discord, all right? I'm posting 20 plus charts a week, giving you guys, some clear levels to take action on when it comes to swing trading. I try to post some day trading setups or scalping setups whenever I see them. And inside of the Discord, you get 20 plus swing trade ideas every week. You get custom scripts and indicators, right? Things that I don't cover in my YouTube videos typically. You get exclusive intel via unusual options activity, dark pool data, gamma levels. The stock bot in there is really amazing. It can even chart Fibonacci's, chart support and resistance. Maybe you're someone who's brand new into charting and TA and you really don't know how to chart. The stock bot in there with some very simple commands will literally do the hard work for you. And on top of all of that, you get exclusive chart layouts such as the one that I've shown you guys in this video, and many, many, many more included as well. It's a really great bargain. And, before June, you guys can get in for just $1 for your first month using promo code May24. Now, if you want something for free, more valuable free content, sign up for the newsletter, right? There's a link in the description. You can get those emailed directly to your inbox. Or if you feel like you need that one-on-one touch, right? I do lots of coaching sessions. You guys can hit me up on my Ko-Fi page right here by clicking on the commissions tab. Okay, and in there you can book a 30-minute or a 1-hour session. They also have this really cool buy a coffee button, basically a way to leave a tip or donation for all the free valuable content I put out, such as these videos and the newsletters. Thanks again for watching. I really appreciate it if you made it this far and you're not subscribed yet. Well, what are you doing? There's no reason not to subscribe. Obviously, you enjoyed the video and you're going to enjoy the rest of the content I put out on this channel because it's very, detailed and thorough, just as this video was.